Hello everyone, my name is Nurshazlana binti Jasni and my metric number is 20D8024 F1072. I will be the first presenter today. I will be presenting on the removal of an auditor at the annual general meeting, which is AGM, and the auditor's right during the process. This topic is important because it ensures that both shareholder and auditors understand their legal rights and responsibility under the Companies Act 2016. Okay guys, let's begin by looking at the legal process for removing an auditor. For the next slide, I will explain about Section 276 of Companies Act 2016, which is resolution to remove auditor from office. Section 276 explains how an auditor can be removed before their terms ends. Okay, what it is? This section gives shareholder the power to remove the auditor if they are not satisfied with their performance. Okay, how it works? Okay, the removal must be done through an ordinary resolution, which is more than 50% of the shareholder must vote in favor of the decision during a general meeting. Okay, the key point is this section acts as the legal tool for dismissing an auditor, but it must be done fairly and according to the proper procedures. In simple terms, shareholder cannot just remove an auditor suddenly. It must go through a formal voting process at the AGM. Okay, now moving on to Section 277 of Companies Act 2016, which is special notice required for resolution to remove auditor. What it is? This section ensures fairness and natural justice for the auditor. It means the auditor has the right to know about their removal and to defend themselves. How it works? Okay, the first step is the auditor must receive the removal notice immediately, so they are aware of the company's intention. Okay, the second step is they have the right to submit a formal written defense, which is explaining their side of the story. Okay, the last step is the auditor also has the right to attend the meeting where the resolution will be discussed and speak directly to shareholder and present their explanation. Okay, these steps are important to ensure that the process is transparent and fair, and that the auditor has an opportunity to respond before being officially removed. Okay guys, we are moving to the Section 278. What is Section 278? This section explains the company's legal duty after the auditor has been removed. Once the company decides to remove the auditor, it must take official action to notify the Companies Commission of Malaysia, also known as SSM. Okay, what must the company do? The company must submit a formal notice to SSM informing them about the auditor's removal. This ensures transparency and that SSM's records stay updated. And here is a key point to remember. This notice must be filed within 14 days after the resolution to remove the auditor has been successfully passed. Failing to do so can cause the company to face penalties or non-compliance issues, since the law strictly requires this time frame. Okay guys, moving on to Section 279, subsection 2 of Companies Act 2016, which is written resolution of a private company. This section is important because it prevents private companies from using an easy shortcut to remove auditors. What it means is that you cannot remove an auditor just by signing a written resolution outside of a meeting. In other words, all shareholders cannot simply sign papers to remove the auditor. That's not allowed. Why is that? Because the law requires a physical or virtual meeting to be held. During the meeting, the auditor must be given the right to speak or defend themselves. As stated under Section 277, so Section 279, subsection 2 ensures fairness It protects the auditor's right to explain their side before being removed, and it keeps the removal process transparent and accountable. Okay, lastly, let's look at section 322, which is about resolutions requiring special notice. This section sets out the rule for giving advance notice before removing an auditor. According to section 322, if a member of the company wants to remove the auditor, they must give at least 28 days advance notice of their intention to the company. What's the purpose of this rule? This 28-day period allows both the company and the auditors to have enough time to prepare for the meeting. It also gives the auditor the chance to use their right to speak against linking back to section 277. In simple terms, section 322 ensures the process is fair, organized, and transparent, giving everyone enough time to respond before any removal decision is made. That's all from me.
Hi guys, my name is Rostana Takin Anakbana. My cut matrix number is 20DPA30083. So today I want to present to you guys about resignation of an auditor. They have 5 important of resignation an auditor is keep the company honest and transparent. Next, ensure a new auditor can be appointed quickly to help find and fix problem in the company. Then, make sure the company follows the law. Lastly is let shareholders know why the auditor left. So next is procedure that needs to be followed. Under section 281, subsection 1 and subsection 2 of the Companies Act 2016 resignation auditor. If an auditor wants to quit or wish to resign from his appointment as the company auditor, there are procedures that need to be followed. The first one is a written notice should be given to the company. An auditor of a company may resign his office by giving a notice in writing to the company at its registered office to the effect. B. The auditor terms of the office ends after 21 days from the day the notice is given or on the date as specified in the notice. C. When an auditor resigns, the company must send a copy of the resignation notice to the registrar SSM within 7 days after receiving. So lastly, section 283 subsection 5 of the Companies Act 2016 rights of resigning auditor of a public company. D. For the public companies, a resigning auditor can send a statement explaining the reason for the resigning and ask the director to call a general meeting. The director must hold the meeting within 28 days after receiving the notice.
Hello everyone, my name is Madeleine Saripa. I will present about company financial statement. First of all, I will present about financial statement and report. By the section 248 of the Company Act 2016, the director shall prepare financial statement. Subsection 1, the director of every company shall prepare financial statement. Subsection A, within 18 months from the date of its incorporation, and subsection B, subsequently within 6 months of its financial year end. Subsection 2, the financial statement refers to in subsection 1 shall be duly audited before the financial statement are sent to every member under section 257, or in the case of the public company, sent to every member under section 257 and led before an annual general meeting under Section 340. Subsection 3. Any director of the company who contravened this section commit an offence and shall, on conviction, be liable to a fine not exceeding 500,000 ringgit or imprisonment for a term not exceeding 1 year or both. By the Section 249, Subsection 1 of the Company Act 2016, General Requirement for Financial Statement. Subsection 1. The annual financial statement for a financial year shall give a true and fair view of the financial position as at the end of the financial year and of the financial performance for the financial year of the company. Next is Section 258 of the Company Act 2016, Circulation of Financial Statement. Time allowed for sending out copies of financial statement and report. Subsection 1. The circulation of financial statement and report. Subsection A. For a private company shall be within 6 months of its financial year end, and Subsection B. For a public company shall be at least 21 days before the date of its annual general meeting. By the Section 259 of the Company Act 2016, Lodgement of Financial Statement with the Registrar. Subsection 1. A company shall lodge with the Registrar for its financial year the financial statements and reports required under this Act. Subsection 1. In the case of a private company, within 30 days from the financial statement and report are circulated to its member under Section 258. Subsection B. In the case of a public company, within 30 days from its annual general meeting and Subsection C. All amounts shown in the financial statement and report lodged with the registrar shall be quoted in Malaysia currency, and if such financial statement and reports are in a language other than the national language or English language, there must be a next language or English language. There must be a next to such financial statement and report a translation in the national language or English language, certified to be a correct translation in the manner to be determined by the registrar. Next, I will present about director reports. By the Section 252 of the Company Act 2016, directors shall prepare director reports. Subsection 1. The directors of a company shall prepare for its financial year a report, and such report shall be attached to the financial statement prepared under Section 248. Subsection 2. A director report. Subsection A shall be approved by the board, and Subsection B shall be signed on the director's behalf by at least 2 directors, or in the case of a single director, that director. Subsection 3. Every copy of director's report laid before a company in annual general meeting under Section 251 or sent or otherwise circulated or published or issued by the company shall state the name of the person who signed the report on the director's behalf. Subsection 4. Any director who failed to take all reasonable steps to secure compliance under Section 1 commits an offence and shall, on conviction, be liable to a fine not exceeding 500,000 ringgit or imprisonment not exceeding 1 year or to both. And the Subsection 5. The company and every officer who contravened Subsection 2 commit an offence or shall, on conviction, be liable to a fine not exceeding 20,000 ringgit. Next is Section 253 of the Company Act 2016. Content of a director report. Subsection 1. A director report for a financial year in relation to a company shall contain Subsection A. the name of every person who was a director of the company during the financial year and during the period commencing from the end of the financial year and ending on the date of the report, and subsection B, the principal activities of the company in the course of financial year including its subsidiary, and subsection C, the matters set out in fifth schedule. Subsection 2. This section shall have effect in relation to a director reports required to be prepared under section 252 as if a reference to the company in subsection 1 is a reference to subsection A, the company, and subsection B, the subsidiary undertaking included in the consolidated financial statement for the financial year. Subsection 3, the director reports prepared under section 252 may include a business review as set out in Part 2 of fifth schedule or any other reporting as prescribed.
Next, shall we proceed to question 9C, accounts and other records to be kept. Section 245, subsection 2 and subsection 3 and Company Act 2016, accounts to be kept. It is a responsibility of company directors and managers to keep the accounts and other records in order to sufficiently explain the transaction and financial position of the company, enable true and fair profit and loss, and also to enable the accounting and other records to be properly audited. Subsection 2. A company, directors, and manager of a company shall cause appropriate entries to be made in the accounting transaction to which the entries relate. Subsection 3. The company shall retain the records referred to in subsection 1 for the 7 years after the completion of the transaction or operation to which the entries relate. Next, we are going to move to the purpose of keeping. First of all, we have legal compliance. It is required by law to avoid penalties. Under Section 245, if the company fails to do so, directors can face penalties or legal action. It shows that the company is operating within legal boundaries and following statutory obligation. Second one, we have to protect stakeholders. It is to ensure accountability to investor, creditors, and employee. Proper records help protect them and so that they could trust the company's financial information is accurate and honest. It is also to prevent misuse of company funds and helps in resolving disputes if they arise. Third, we have financial transparency. It is to enable accurate reporting to shareholders and regulators. Keeping complete records make it easier to show where money comes and where it goes. This builds trust and confidence among investor authorities and the public. Transparency records also discourage fraud and financial manipulation. Fourth, we have audit and inspection. Auditors need proper records to verify transactions and check accuracy of the financial statement. During inspection of SSM or tax authorities, having organized documents ensures smooth compliance checks. It also saves time and avoids penalties if the company is audited suddenly. For the last one, you have strategic decision. It is to provide data for budgeting, forecasting, and planning. Accurate records give management a clear picture of the company's performance. Good data means better business decision and it gives a stronger company growth. Next, we are moving to types of records to be kept. First, we must know that accounting records must be accurately reflect the company's financial position. This means the record should clearly show the company's true financial situation by knowing how much money owes, earns, and spends. Accurate records help management, shareholders, and auditors know whether the company is doing well or facing loss. Second, enable preparation of financial statements. The main purpose of keeping records is to make sure it is possible to prepare financial statements like the income statements, balance sheet, and cash flow statement. Without proper records, these reports can be prepared correctly. Next, include records of assets, liabilities, incomes, and expenses. These are the core elements of accounting. Asset: what the company owns. For example, cash, building, equipment. For liabilities, what the company owes, which is loans, debts, or debenture. Income is money that the company earns. Expenses: money the company spends. Keeping track of all this to ensure the company's accounts are complete and reliable. Appropriate entries in accounting and any relevant records within the 60 days. Every financial statements like sale, purchases, or payments must be recorded properly within 60 days after it happens. This keeps the company's record up to date and prevents missing or forgotten transactions. Other records include minutes of meeting from board of directors and AGM. These are written notes that summarize what was discussed and decided during meetings. They served as official proof of company decision, showing transparency and accountability of the company and boards and members. Second, register of members, directors, and secretaries. These records list all are all shareholders, members, company directors, and company secretary. It ensures that anyone can identify who owns and manages the company by promoting transparency and compliance. Third, we have constitution if adopted. The constitution is like the company's rule book. It outlines the it outlines the intel on how the company operates, how meetings are run, voting rights, and more. If a company has one, it must be kept safely for reference and compliance. Last, we have share certificates and others reports. These documents prove that ownership of company shares and records any transfers. When someone sells or buys shares, keeping them prevents disputes about who the real owners are and ensures accuracy of the members' register. Additional information here is records are kept at least 7 years at the registered office or another location notified by the registrar. All these records must be safely stored for at least 7 years, usually at the company's registered office. If they are kept elsewhere, the company must inform the registrar (SSM). This ensures records are always accessible for audits, inspection, or reference. Next, we are going to move to responsibilities that is placed on the company directors and manager. First one here, we have company's duty. Company ensure records are kept in a legible and accessible format. The company must make sure all accounting and financial records are easy to read and can be accessed whenever needed, either physical copies or electronic format. Second one here is we have notify the registrar (SSM) if records are kept outside Malaysia. This keeps everything transparent and traceable. Third one, we have prepare annual financial statements and submit to SSM. Each year, the company has to prepare complete financial statements that show its financial performance and position, then submit them to SSM within required time frames. Second, we have director's duty. The primary duty is to ensure proper accounting records are maintained. They must approve financial statements before submission. Before financial statements are submitted to SSM, directors must review and officially approve them, showing they take responsibilities for the accuracy of the documents. Third, we have the rights to inspect accounting records at any time. Directors can check and review the accounting records any time to monitor the company's financial activities and ensure compliance. Directors Directors' duty also can be held personally liable for failure to comply, including fines or imprisoned managers' role. If directors neglect their duties, for example, failing to keep proper records, they can face legal penalties, including fines or even imprisonment under the Companies Act. For the last one, we have manager's duty. Manager assists directors in maintaining records. Manager help directors by organizing, updating, and ensuring all account and business records are accurate and complete. Second, to ensure day-to-day transactions are recorded properly. Manager must make sure every daily financial transaction like payments, sales, and purchases is recorded correctly in the books. Last, support audit and financial reporting process. During audits of financial report, manager provide necessary documents and explanations to make sure the process runs smoothly and accurately. Next, we are going to move to question 9D, Consolidated Account. Section 250 of the Company Act 2016, subsidiaries to be included in consolidated financial statement. We are going to discuss about the main thing in this topic, the mandatory consolidation. The holding company, which is the parent company that owns one or more subsidiaries, is required by the law to prepare consolidated financial statement. This statement combines the financial result of the parent company and all its subsidiaries into one single set of accounts showing the overall financial position of the entire group. For example, if a company A owns a company B and C, the company A must prepare one report that includes company A, company B, and company C together and not separately. For alignment of financial year, the financial year end of the subsidiary must match the holding company's year end. This makes sure that all financial data is from the same time period so the consolidated statements are accurate and consistent. Subsidiary may be excluded from consolidation only if sometimes a subsidiary doesn't have to be included in the group accounts but only under special condition. These exceptions are it is not important to the group's overall financial position. If the subsidiary is very small or insignificant, excluding it won't affect the overall group financial result. Second, inclusion is impractical or would be misleading. If combining the subsidiaries data would cause confusion or doesn't reflect a true financial picture, for example, due to different accounting methods or incomplete dates. Third, it is held exclusively for resale and meets specific criteria. If the holding company owns this that subsidiary temporarily just to resell it and not as long-term team business investment, then it doesn't have to be consolidated. In short, under Section 250, the parent company must prepare consolidated financial statement for all subsidiaries unless they fall under certain exception. This ensures the company group's financial position is clear, accurate, and transparent for stakeholders and regulators like SSM. Other than that, consolidated accounts show combined financial of parent and subsidiaries as one group, includes asset, liabilities, income, expenses, and cash flow. The purpose of this consolidated accounts is to show full picture of group's financial health. Second is for investors' confidence. It is to help investor assess risk and performance so that they would know where which company to invest. Third, regulatory compliance. It is required by the law, which is Section 250 Company Act 2016, and also to avoid penalties. For this example, I already discussed from the previous slides. Next, we are going to move to the very last one of this question, which is annual return. First, we are going to learn about the contents of the annual returns. First, we have registered office address. Second is nature of business. Third is location of register of members if not at the registered office. Fourth, address of business location including branches. Fifth, location financial records if not at registered office. And the last one is shareholding structure including debentures. For companies, this is for companies with the shareholders. Annual return is in Section 68 of Company Act 2016, duty to lodge annual return. I'm going to just compact all of those from the subsection into some of the words, which is every company must lodge an annual return with the registrar within 30 days from the anniversary of its incorporation each year. The return must be in prescribed form and contain particulars as required by the registrar. The return must be lodged electronically via the system approved by the registrar, for example, My Co-ID. Last one, this section does not apply to a company in the year it is incorporated. Next, consequences of not lodging annual return. This what will happen if a company doesn't lodge annual return. First, striking off. A company may be removed from a register after 3 years of non-compliance. If a company fails to lodge its annual return for 3 consecutive years, the registrar SSM has the power to strike off or remove the company's name from the registrar. Once struck off, the company ceased to exist legally. It cannot operate, enter into contracts, or hold assets in its name. This is basically like being shut down by SSM due to long-term negligence. Second is fine up to 50,000 ringgit for the company and its officers. Both the company and its officers, directors, secretaries, etc., can be charged a fine up to 50,000 ringgit for failing to submit their annual return within the required period. This penalty emphasizes the seriousness of compliance, director personality responsible, not just the company itself. Third one, you have loss of good standing. A company that fails to lodge its annual return loses its good standing status with SSM. This means it may face issues difficulties in getting loans, renewing license, or securing government contracts. It also damages the company's reputation. Investors, consumers, and partners may lose trust. The last one is daily penalty, 500 ringgit per day until return is submitted. Apart from the main fine, SSM may impose a continuing penalty of 500 ringgit for each day the annual return remains unsubmitted after the deadline. This means the longer the company delays, the more expensive the penalty becomes, encouraging a quicker compliance. In summary, failing to lodge an annual return doesn't just cause fines, it can ruin the company's legal status, financial standing, and reputation. So, timely submission keeps the company legally active, trusted, and in good compliance with SSM.
Hello everyone, my name is Bernard and I will be presenting about submissions of account for audit exempt companies. Firstly, we have preparation of unaudited financial statements. What is it? It is fundamentally the same as for any other company, as the legal requirement for statutory compliant financial statements remain absolute. The responsibility for preparing the financial statements rests with the directors ensuring a true and fair view of a company. The accounts need to be prepared are a statement of financial position, statement of comprehensive income, statement of changes in equity, statement of cash flows, and notes to the financial statement. Notes to the financial statement contains critical accounting policies and detailed disclosures, which cannot be omitted. Next, we have the accounting standards. The statements must be prepared in accordance with the approved accounting standards in Malaysia. For most private companies, this is the Malaysian Private Entities Reporting Standards. Next, we have the approval or the endorsement of directors. The complete set of statements must be accompanied by the following mandatory reports and statements. Firstly, the director's report, and secondly, the statement approved by directors. Next, we have an audit exempt certificate. What is it? It is the approval to skip annual audit for qualifying private companies. It is valid for one financial year and companies must requalify annually. Who can apply? Companies that have met SSM criteria such as dormant or zero revenue companies and companies whose revenue do not exceed 3 million ringgit, total assets do not exceed 3 million ringgit, and the number of employees do not exceed 30 at the end of the financial year. What is the purpose? This certificate must accompany the unedited financial statements when lodged with the Companies Commission of Malaysia. The certificate must explicitly state the following. Firstly, the companies qualify for the audit exemption for the relevant financial year as per criteria stipulated by the SSM's Practice Directive. Secondly, no member has requested the company to perform an audit of its accounts for that year in accordance with Section 267, Subsection 3 of the Companies Act 2016. Lastly, the directors acknowledge their responsibilities for maintaining proper accounting records and preparing financial statements in compliance with the Companies Act 2016 and compliance with accounting standards. Next, we have circulation of unaudited financial statements. What is it? Circulation is the act of providing the final financial information to the company's owners. The requirements are that the company must send a copy of the unaudited financial statements along with the director's report and all accompanying statements to every member of the company. Next, we have deadline, which is the documents must be circulated within 6 months of the company's financial year end. And even without an audit, the circulation is still mandatory for transparency and compliance. In addition to this, no requirement for AGM. Unlike audited companies, a private company is not required to hold an annual general meeting to lay the accounts. This is due to the circulation being sufficient enough to meet statutory requirement. Lastly, we have lodgement of unaudited financial statements. What is it? Lodgement is the final step where the statutory documents are submitted to the SSM, making them public records. What to submit? Unaudited financial statements, director's report, statements by directors, statutory declaration, and audit exemption certificates. Lastly, there's a timeline where the lodgement must be made with SSM within 30 days from the date of the financial statements and reports are circulated to its members. And compliance required even without audit, proper lodgement is mandatory under the Companies Act 2016.